Hey, what's up, traders and investors? Bennett Tyndall with TradingAnalysis.com, Thursday afternoon, September 8th, and today we're here to talk about the 2022 market decision. Is it time to finally retire the bull that sits prominently behind me on the wall? Should I be bringing out the bear claws? Or has this simply been a complex garden variety market correction? Sit back, relax, we'll go full screen on the charts and show you exactly what to look for in the markets next. And going full screen on the trading analysis edition of the Motive Wave platform. Before we're getting started with the hard right edge chart analysis, I do want to take just a quick moment of your time to address those of you tuning in who are perhaps new to the Elliott Wave principle. Maybe you are familiar with how we use it to manage risk, but you are not familiar with how we have used it in the past to successfully trend forecast markets. So I have put together two different examples, one from the cryptocurrency markets going back to April 23rd of last year, and you can find this post on my Twitter profile if you're interested. It was April of last year that we had noticed the price action in Bitcoin meeting what appeared to be a Wave 3 completion. And if you'll notice here, we had approached and had met a near 200% price relationship to the Wave Blue 1, and we did so in nearly exactly 200% of time elapsed in Wave 1, meaning the rally that we see from Wave 2 into the Wave 3 high was nearly exactly 200% in magnitude and duration compared to the Wave 1 of the same degree. From there, Elliott Wave told us to expect Wave 4 to complete as early as January and as late as June of 22 and into a major support zone between 18.5 and 22,000. And if you've been following price action in cryptocurrency, you know that this chart has unfolded and we have moved right into the 18,000 handle as of June of this year. Now, the other example that I have really quickly for you is taking you back to the summer of 2019. And it was in the summer of 2019 that markets had rallied successfully from the December 2018 lows. And this is the exact chart that I had published coming out of the summer consolidation in 2019. And in this particular chart, if I zoom in, you will see that I was essentially looking for a move up towards, call it 3,200 to 3,314 in the S&P 500, at which point the Elliott Wave interpretation of the market suggested that that zone would yield a sharp decline back to the December 2018 lows, or perhaps even exceed the December 2018 lows. And if we zoom in, and speaking of risk management, just to take this a step further, the entry that we had established near the 2880 level in the S&P back in the summer of 2019 offered an invalidation of trend at 28.25. So said otherwise, an entry at 28.83 offered a stop loss at 28.25 with a take profit objective of 3,200 to 3,300. And if we look at what followed, as you can see, the breakout successfully occurred. We ended up printing a high of 33.93 before the coronavirus pandemic came about, set the social mood up for a very sharp decline. Now, what's beautiful about this chart is I initially had this mapped out as a triangle, but the coronavirus came along and established, set the social mood up and set us up for a more impulsive decline, which turned the overall fourth wave move into a flat correction. Now, let's go ahead and zoom in and take a look at the current trading action in the S&P 500. And looking at the S&P 500 going back to the January high, we see what appears to be a series of three-wave corrections, which we are calling and labeling essentially a complex correction, which is a combination of the Elliott Wave corrective patterns. And in this case, we see a zigzag in Wave W and a zigzag in Wave Y, and we are also expecting another zigzag in the Z-wave position. Now, before moving forward, I will take you to one of the charts that perhaps you are more familiar with, and that was the chart that you see here. we discussed this chart earlier in August, talking about the fact that we had a setup which was identical to that of the February 24th through March 30th rally, where we saw the S&P 500 move up, move down, move up, and then enter a retracement. At the time, we knew that this could have been wave 1, wave 2, wave 3, wave 4, and wave 5. However, we knew in the event wave 4 exceeded 44.1678, that would call for uptrend invalidation, which would also simultaneously act as downtrend confirmation. What ended up happening is we overlapped into the price territory of what would be wave 1. Therefore, we met the uptrend invalidation trigger. That uptrend invalidation trigger was met into April. We then retraced in three waves and continued to break south of the February 24th low in the index. So going back to the June 17th index low, coming up off of the low, we had a move up in 1 or A, down in 2 or B, up in 3 or C, and down in 4. Or, alternatively, we knew that this would prove to simply be up in A, down in B, up in wave C, which was exactly what we had back here into the March highs. The 44.16 level, in this instance, came in at 39.45.86, meaning we knew if this correction exceeded that level, it would call for an invalidation of the bullish uptrend and suggest that we simply rallied in 3 waves. This was a corrective rally, and we are now going to experience another 3-wave decline, likely into new lows for the year. So this remains my preferred view. And in fact, going back to the 16th of August, I was able to identify the completion of this move and short the market about an hour before the turn lower. So now that we've invalidated the uptrend on the year, my preferred view has us moving lower in a 3-wave move. And I published a chart on Twitter to that effect earlier in the week, discussing the downside targets and bringing your attention to what should occur next and when and where the most logical entry opportunity might present. And for those of you who are not already short or risk off the market, I feel the next most logical entry opportunity will present once the initial 5-wave decline from the August 16th high completes, and we are then met with some sort of a corrective retracement in the B-wave position. Depth and duration of the B-wave correction is unknown, and as a result, I personally wouldn't be interested in trading the corrective rally that I expect to see print in B. I would instead be awaiting that 3-wave retracement to put on additional positions on the downside for a move under the 36.36 low from June 16th. Now, this is what I view to be the best case scenario. In the event we are met with some sort of an unexpected upside catalyst, the only way to keep this uptrend alive is to absolutely force a 5-wave trend up. And this is a case where I wouldn't feel comfortable doing that. So I feel that we have a 60 to 65% chance of making new lows and only a 30 to 35% chance of holding a retracement of the current upside rally and then turning back to the upside. Now, it is worth noting that the areas of support on watch currently include the June through July trend line, which you can see here is more or less where we found support on the 6th. In addition to that uptrend support line, we also have a Fibonacci retracement of that upside rally, which you'll notice we have confluence of the 786, the 618, meeting uptrend line support. This is very short-term uptrend line support, and I do think that it is either wave 3-4 of an initial 5-wave move down, which now we can focus in on everything from June 16th on. So I'll go ahead and move you from the half-day chart down to the 1-hour time frame. Here on the 1-hour time frame, we can see the developments from June in through August, a 2-month rally, ended with a beautiful ending contracting variety diagonal. I called the end of this 5th wave on Twitter as well, so I would encourage you to follow me there if you're interested in more Elliott wave charts and commentary. And I mention that not to toot my own horn, but to emphasize the validity of the Elliott wave principle and perhaps encourage you to consider learning it or at least exploring it further. I give Ralph Nelson Elliott, who discovered the wave principle, credit for any market call or opportunity that I'm able to capitalize on. So looking at this trend, I see this as either 5 waves down in the making, and we're in the process of making a wave 4 with resistance up to 40.15 that should give us a 5th wave move down. I am expecting that 5th wave move, if it occurs, to take us below uptrend line support, likely overshoot and overthrow the 618, perhaps bounce at a series of swing wave highs that turned into swing wave lows and support here. But from there, once we have 5 waves down from the August 16th high, I expect to see 3 waves back, and this 3-wave move is where the market will truly confirm a breakdown south of 3636 in the S&P 500. Now, we have to address the elephant in the room and the more remote bearish possibility. If you have been following my work for any length of time at Trading Analysis, perhaps you are familiar with my more bearish NASDAQ interpretation, which I presented at the Elliott Wave Hub Conference and have presented multiple times in the past. And I actually have a series of charts ready to go for this discussion. So allow me to delete the commentary, my apologies, and we will start this discussion out on the monthly time frame. And looking to the monthly time frame, we have to take into consideration the entirety of the NASDAQ 100's history going back to its inception in 1985, where we see the initial makings of an impulsive motive trend to the upside into the .com 2000 highs. From there, the market corrects in 3 waves or 7 major swings, meeting a 50% retracement of the orange wave 1 rally. From there, we proceed to rally in another 5-wave trend, finishing into November of 7. We then correct into the credit crisis lows in a wave 2 position, and it's from November of 2008 that we begin a beautiful 5-wave journey up into the November 21 area resistance. Now, you see a few notes on here, but these notes don't quite make sense, so allow me to erase those, and we will take this one wave at a time. So looking to this chart, we've discussed the fact that the base trend channel, which is offered from the 2002 through 8 lows projected over the .com highs, the base trend channel offered resistance, and more recently has been tested and bounced and acted as and offered support this year. Now, the zone that we ran into resistance in November of last year happened to be at a major 261.8% Fibonacci projection of wave 1, meaning wave 3 met 261.8% in price compared to wave 1, which is very similar to the 200% discussion that I showed you when looking at the chart of Bitcoin. In addition to the 2618, we also had cycle wave 5 and 1 equality come in, as you can see here, at 16,068.03. Meaning, we had a confluence of 2 of the most common Fibonacci objectives in a motive sequence, offering resistance in November of last year. The 2618, and then inside of wave blue 3, we have 5 and 1 equality, which is extremely common when you have an extended third wave position, which we absolutely do, given this green 3 was 161% of green wave 1. Now, another very interesting note that it is worth bringing to your attention is the fact that orange wave 3 concluded at or near a 261.8% time relationship to wave 1. Green cycle degree wave 3 finished at or near a 261.8% time relationship to wave 1. The blue wave 3, where it met the 2618 price relationship to wave 1, believe it or not, happened to also be about a 2618 time relationship to wave 1. So perhaps this is a very common theme And we did, in fact, complete super cycle degree wave 3 into the November high for the NASDAQ 100. Now, orange 3 and green 4, orange 4 and green 4 were both sideways trends offering alternation to the wave 1 of the same degree. Thus far, the move down in the NASDAQ, which we can now move off of the 1 month and take you down to the weekly and the daily. Here on the daily, we can see the fact that the NASDAQ did not like the fib cluster between 15.8 and 16,000. And this was the zone that at the June Elliott Wave Hub conference in 21 I suggested could shut the NASDAQ down for at least a corrective retracement and could offer us some troubles. It does appear as if that zone has spoken. And we can technically count this as a motive 5-wave trend down in the NASDAQ 100. We have a very weird leading contracting diagonal down, 3 waves up. We complete 5 down, 3 up, 5 down, a flattened 4, down in 5. And you see this green squiggly line, which we referenced on the monthly chart, bringing your attention to the fact that we bounced at the base trend channel, which previously acted as resistance pre-COVID sell-off. Down to the daily chart once again, that bounce where we completed 5 waves only managed to deliver a 7-swing price structure or a 3-wave move, A, extended B, 5 of C. The base trend channel bounce only managed to offer a rally back into downtrend line resistance from the all-time high through the wave 2 high, which is precisely where we were shut down on August 16th. And now we have to consider the fact that we have breached uptrend invalidation. We have breached uptrend invalidation just as we did in the S&P 500. So although we have to go back to the S&P now, although our preferred view suggests that this is simply ABCW, ABCX, ABCY, ABCX, ABCZ to make a triple combination correction in a very complex economic environment, although our preferred suggests this to be the case, in the event the 3-wave retracement that we have mapped out on this chart is not met with a meandering wave 5 or 5-wave move down rather that perhaps demonstrates some sort of positive momentum divergence compared to wave A. Let's say we don't move down in 5 waves at a less significant angle of descent compared to wave A, because typically your C wave is a less significant angle of descent, not always. So let's imagine on the move down, instead of meeting support at 36 and 3400, which is our downside objectives for the year, if we instead are met with acceleration of trend to the downside, then we need to be aware of and respect what the more bearish scenario in the case of the NASDAQ may be suggesting. And that may be suggesting to us that, in fact, the fib zone was entirely valid, and this is a much more significant cycle or supercycle degree top. Now, what that means is that we have 5 waves down. Remember, 5 waves down gave us a bounce at the base trend channel. That only gave us 3 waves up and into downtrend line resistance. So if markets fade lower from here with acceleration, we need to be aware of and respecting the more bearish scenario. So the 2022 decision awaits. We already navigated the near-term decision, and that was either securing the June lows as the end of the correction or dismissing the June low as the end of the correction and offering evidence to substantiate new lows, which I believe we now have with the breach of uptrend invalidation. And then it is worth noting that the bounce failed downtrend resistance, and now if we see acceleration, interestingly enough, if we are to measure a quality of C compared to wave A, wave C being equal to wave A, or said otherwise, if we are to see another decline that is equal in percent change to the decline that we've seen thus far, off of the November highs into the June area lows, that level comes in at 9,033.24 in the NDX. What's so very fascinating about a quality of C compared to wave A is if we draw C to our equality level in price, where does that take us? That takes us right to the 1-3-2 Elliott trend channel, which is a channeling technique that is specific to and part of Ralph Nelson Elliott's original wave principle. So that's the next course of action. We have, as mentioned, helped you to navigate the initial 22 decision, and that initial 22 decision was, is this going to hold as wave 4, or are we going to breach uptrend invalidation? Now that we've breached uptrend invalidation, I believe we have a 60 to 65% probability of making new lows. I still think the next logical short opportunity for those who are not already risk off will be presented in the B wave retracement. And then now that we're through this decision, which dismissed the uptrend and confirmed new lows, in my opinion, the next major decision will come within this descent. Does this descent stop at support, or are we going to see acceleration of trend? And perhaps in addition to acceleration of trend, we're met with an unexpected bearish catalyst. So that's it from me. Hope you enjoyed the update. I know this was a long one, but there was a lot to cover, and I felt it would be a good video and a good topic to address. I will leave you with these charts here. Here we can see the base channel resistance, January of 20, offering support. That base channel, as you can see, in addition to that, we have a very common 2618 relationship in time of wave 3s compared to wave 1. The bounce from the corrective trend channel only yielded a move back to downtrend line resistance. And now, interestingly enough, drawing a quality of C compared to wave A takes us right to our 1-3-2 channeling technique, which could spell trouble for the markets. Finally, last but not least, I will bring you a quick update on what we discussed Tuesday in our Tuesday video and Tuesday email update, and that was the decision zone on the horizon for WTI crude oil. And following our discussion Tuesday into yesterday, we saw WTI crude oil decline rapidly to $81.20 a barrel. We have since seen a move back up towards $83.95, and this is it. This is the make or break zone. We have the overthrow beyond the corrective trend channel in green. If we do bounce at the 1-3 trend line and see an impulsive upside move, we could begin to substantiate perhaps the idea that this has only been an ABC corrective retracement. There was a comment on the video Tuesday regarding the subdivisions of the 1 and 3 position. I believe the subdivisions of the 1 position, the wave 1 position, to be a 1, 2, 3, 4, 5, 6, 7 swing 3-wave structure. I will admit the 2 through 3 decline looks to be a 5-wave move. The issue with calling it a 5-wave move is you end up with overlap. And then here's the other major issue that I wanted to address. The reason I have these as 3-wave moves is because if this is an ending diagonal, waves 1, 3, and 5 should have 3-wave subdivisions in an ending diagonal. There's also no valid way to count this sequence truly as motive, unless we really force a 4th wave and anchor 4 here and call that a very short abbreviated 5th. So keep your eyes on WTI crude oil. Major decision is upon us. Do we hold here? Or perhaps the historical RRG comparison that I presented the first week of August that says this may be wave 5. Maybe that is true. And if that is true, our first sign to that effect will be a break of downside support and mostly a break of down the 80 handle to the downside in WTI. So that's it from me. I hope you enjoyed the video update. As mentioned, I know it was a long one, but I do feel it was important. Keep your eyes on the hard right edge of the market. Check us out anytime at tradinganalysis.com. If you did enjoy the video update, if you enjoy the video format, please give it a thumbs up, comment, subscribe with notifications. If you do and you do enjoy the Tuesday, Thursday updates, I will continue to pump these out every Tuesday, every Thursday. Perhaps every Tuesday or Thursday we cover the indexes, and then the other day of the week we can cover individual charts. We'll take it one day, 1 week at a time. It's a very interesting market environment. Okay, appreciate you all. Thank you for tuning in, and we'll see you guys on the next public market update. Take care.